So we've covered like why do we actually use debt. We started with like why and why is it actually important for people to understand and utilize it properly. So let's talk a little bit about what are the kinds of debts that we have on the market. We always hear about people talking about like higher purchase loans or like personal loans, home loans. In the equity space, we got like the margins, we got leverage in crypto. But is there like a very definitive I would say categorization for all these debts, Aaron?
Yes, I would say that what Steph mentioned, okay, I would say that there's two main types of debt lah. Okay, and then basically the rest of the categories are just subsets of them. Okay, the first type of debt is what you call a secured loan, meaning you put up collateral and then the bank lends you the money based on the market value of the collateral that you're putting up. Mortgages fall under this category because usually when you want to buy a house wherever country you're in, right? The bank will come in, they'll assess the capital market cap of the mortgage, right? And then they will allow you to borrow as much as 90% of the asset or sometimes 100%. And whether or not you can qualify for the home loan also depends on the second variable, which is your income and your credit history, right? So this income and credit history falls under the category of unsecured loan, meaning, and these are where, right, things like personal loan, personal loan, credit card, then you're talking about all this like, things which don't really have a collateral, right? But basically comes from a premise, right, where it depends on your promise to pay the bank based on your, established income. So things like personal loan, which is why when Steph, you mentioned that the two biggest like default and bankruptcies often come from personal loans, right? It's because usually in personal loans it is an unsecured loan and there's no collateral. So usually, right, when you want to borrow money for things like personal loan, your interest rate is usually the high end of the spectrum because towards the bank, right, there is higher risk for them. Because assuming, let's say, a person were to default, right, because they have no collateral, unlike the house, they cannot just foreclose the house, they cannot just force sell the house, and they cannot take the house back. So they basically have to like just lawyer up, and depending on how much you owe, right, they'll come and chase after you. And in order to make sure that they don't actually like overcommit their personal loan to most people, each bank usually have a limit as to how much they can lend. So usually the limit is anywhere between 3 to 4 months. All right. So this is basically unsecured and secured. Now, if you go down to the secured loan parts, which basically a lot of people also get into trouble in, right? It's basically because these loans, right, they are also in most cases are mark to market loans. Okay, meaning, for example, let's say you were to buy a house at let's say you buy a house, let's say $1 million, you borrow 90%, 900,000. Assuming, let's say, something like a 08, 09 crash were to happen, okay, then suddenly the valuation of house, right, go from 1 million overnight, right, market value drop to 500,000. You still owe the bank 900,000. The 900,000 don't go away, all right? The bank will call you and say, okay, because the market value of this flat has dropped from 1 million to 500,000, the maximum that we can lend is 900K. Okay, can you please cough out another 450,000? If not,
Oh,
we'll sell the house and then we'll basically get a lawyer and basically claim on your asset in a personal capacity. Okay, now you think of this situation is bad, right? All right, now multiply this number of purchase by 5 to 6 times. All right, because this is exactly, right, what happened in the 08 and 09 crisis, where many people, right, they bought houses, right, at 1 million, and overnight the houses, right, some of them own 5 to 6, right, overnight the houses dropped by 50%,
my
and they were
God.
told, right, to cough up $2 to $3 million instantly overnight, or the bank will force sell everything, and then they will just come after them and declare them bankrupt.
My God. That's insane. But that's really over leverage, isn't it?
It is, I would say that it is mark to market. I would say that from this story, you have to understand, right? It doesn't mean that you go secured loan, right? It doesn't mean that if you take a secured loan, means it is risk free, because people forget, even if it's a house, sometimes houses also can the valuation can drop also. It's not a never, that's what a lot of people forgot in 05, 06, right? They always thought that houses will never drop, houses will never default. Then 09, 08 happened, right? And then overnight the houses dropped by 50%. And I have people, right, in some of my friends are in Singapore who are that old, and they went through that 08, 09. I have a few of them, right, during that time, the banks literally called them up, and because they own like 3 to 4 houses, right, okay, the bank called them out and basically asked them to top up their margin because they got margin called on their homes in Singapore.
Wow.
Okay, and
Wow.
that was a real thing that happened. Okay, in 08, 09. I'm pretty sure it also happened in Malaysia. Okay, because if America happened, Singapore happened, I'm pretty sure Malaysia happened as well. So when you talk about debt, right, just understand that whatever kinds of debt are mark to market, credit card, interest free loan, cash flow loan, understand the fundamental principle is that when you own asset until you pay off the debt, that's a fundamental principle that you need to understand. Right. So that is why it's so important that when you take on loans, right, and when you utilize this asset, as what Steph say, make sure that when you buy something, right, make sure you do your due diligence before you jump on.
Yeah.
Steph, what do you think is prudent for a person who is buying property? First time buyer, like future buyers, what should they look out for when they buy a property? And also, like, what is some good guidelines for them to, in terms of debt financing?
Yeah, actually I find that there's quite a few traps in the property market, especially for first time home buyer. As I shared, it's really important to know your eligibility and your affordability, and if possible to borrow below your affordability instead of on your affordability level or above. Because I find that while interest rate was low, but now it has increased and may not stop there, it's important to really factor in the possibility of an increase in interest rate and whether when that happens you can still afford it. And another property trap that I find really that's still ongoing, even being brought up by the House Buyer Association in Malaysia, that there's this ongoing cashback that is being offered, so-called to help stress on buying the first home, where they can zero down. They don't have to come up with down payment to buy property, but be careful of that because you are in a way actually paying for that cashback, because a lot of people get into more debts because of cashback being offered by developer for developer who want to clear off their units. So I think that's a property trap that people need to know and which I see that a lot of people buy property for the reason of they need a house or they want to invest, but instead they want to get on more debt to clear their bad debts. And in a way, it's like debt consolidation as well, of which I'm sure, Aaron, you are able to show as well on that, the debt consolidation.
Oh, that's insane.
Yeah.
That's very dangerous.
Yes, it is.
Well, that's like huge red flag. Like when you say that people don't have to like come out money down and then buy a house, right? That really screams like 08, 09 crisis, because back in those days, really people like they don't even have to show credit history, to borrow money to buy a house.
Wow.
Yeah, they don't even have to show that they have income. You can be unemployed and still buy a house, because of the political regulation there. So you're saying, Steph, that people right now they buy property because they don't even need a place to stay. They don't even need a place to like invest, but they're buying it because they want to do debt consolidation.
Yeah, that's one of the reason, as well as for the cashback, because they need the cash to, like, let's say for capital of business and things like that lah. But that is very something to be careful of lah, I find, because those that don't have the personal finance knowledge can be lured into that. So I think the intention that you are getting the house is very important.
Actually, out of curiosity, Steph, when you say some people are doing this, is this something which is very uncommon, like in terms of percentage wise, like less than 1% of people actually do this, or is actually quite scary amount?
I would say it's getting more and more popular, especially with purchase, but it's not very often talked about because actually it's quite a gray area. Actually, banks are trying to control it, but I find that banks also have their own KPI, like how much they are able to sell outright. So I
Yeah.
think it's a supply and demand thing. The reason people can into all this is because they see the potential of making profit, like as a way to get more money. But little do they know they actually have to pay back on. This cashback is not free. On SPA, on the sales purchase agreement, you are buying something, let's say 1 million, whereas the real value is only, let's say, 600,000. So you're actually getting more debt, which is like 400K more debt than you actually
Wow.
need. Yeah. So and in a way you are kind of like manipulating the bank or the system in a way. So I think that's one thing to look for, that is not free, it's being taught about quite a lot lah.
Oh my
And
god.
this is all quite new in the sense that it's still in the gray area. It's rather unregulated, and it's also just a very new marketing agenda from the property scene, the developers and all.
Actually, it's not that new. When I first entered the property industry, it has already been happening. In fact, it's more like a closed deal, meaning a good deal.
Actually, I
Because
think I know what.
yeah, it's limited.
Actually, this thing it breaks my heart to hear this, because like usually when things like this happen, right, the one who really suffers are those people who want to generally buy a house, right, for
Yes,
to live in, right, and then because of this, right, the houses are actually artificially inflated.
yes, very true.
Because what Steph is essentially saying, right, is that people basically borrow money from a bank due to inflated property prices, and then they take the cashback that's given to them, right, and then essentially you have a artificially inflated property price lah, which is why just now, before the podcast started, right, I say that it's usually a sign of a property bubble, right, when you need 3 generations of money just to buy your first home at the age of in your 20s, is usually a sign of a property bubble. Because like when you include like interest rate increments, then you see stuff like that, right? The question is, right, when all of this suddenly stops, right, like what happened in Japan, the property prices were increasing like nobody's business, right? Essentially, when the Bank of Japan stepped in, right, and then they pulled the rug, a lot of people, right, committed suicide. A lot of people, because basically they really went up to their necks and they couldn't afford to pay the debt lah. So I think actually, Steph, thanks for sharing this, because I think this is something which we don't hear about very often. In a lot of I think the main issue that I have whenever I look at property marketing, right, is that there are many things like that which occurs, right, which is not usually talked about, and this is, I guess, one of the large contributing factor, right, as to why property prices have been high, I would say, relative to a person's income.
Yeah, it kind of makes sense now that like property prices in Malaysia, I'm not sure about other countries, but in Malaysia it has been going up very aggressively, even though like in KL, right, we know that there is a massive oversupply of property. Like there's just been more and more townships being built around the Valley area, and but then somehow these new developments, they have the launching prices just keeps going up and up and up like nobody's business. Now
Well,
you mentioned this makes total sense because it's being inflated artificially in that sense, and it sounds like a Ponzi scheme to me. I don't know.
Okay, I guess a question to you, Steph. I just wonder, right?
yeah.
In terms, I guess the best way for me to come from to look at this, right, and is to basically ask the fundamental question, and that is, in your area that this is happening, right? How is the resale market doing
The resale
relative
market,
to the new
meaning the
launches?
secondary market.
Yes, relative to the brand new launches, how is the resale market doing? Are people having trouble trying to sell their homes?
Actually, the sub-sale market, which is the secondary market, is doing pretty well because there's still value there.
Okay, I guess the better question, right, is in terms of pricing, right? Like generally, do you feel that the resale market tends to be more conservatively priced compared to new launches?
I would say it's a 50-50. There are some really good value in sub-sale still, but there are also sellers that are trying to take opportunity of the market, especially if the area is in high demand, to also jack up their price. I think it's normal lah. We all want to sell as high as possible, but there are also desperate seller who want to sell off to liquidate the asset for any. But I still find that there's more value in sell because you can negotiate for the price.
Oh, okay, that makes sense.
Yeah.
Whereas if you go for a new launch, you cannot negotiate the price lah.
Yes,
see.
yes. Unless the developer is desperate enough, is really desperate to clear off the stock lah. Because the longer they hold the stock, it also incurring costs to themselves.
Yes, that's
Well, guys, that is some insight from Stephanie. I always like to ask this type of questions because I find that it does give you some insight towards like the property market there. Okay, so we have touched on kinds of that. Okay, I would say that we have spoken a lot about like let's say basically, personal loans as well as mortgage loans, right? And then now I want to focus the conversation on debt structures, and that is basically talking about things like how do you best structure debt, right, to make it work for you, right? So, for example, like Ryan, you mentioned that you purchase a car, right, which is a debt structure that you borrowed at 2 point something percent over a 10-year period versus a property where you borrow. Actually, Stephanie, when you buy a property using debt, right, in Malaysia, how common is it for people to borrow 35 years?
Actually, it's quite common for people to stretch as long as possible, especially for those under 35.
Uh-huh.
Yeah. So you can stretch it until you're 70 years old. So as long as you're below 35 years old, you can stretch. You can choose to get until 35 loan tenure.
But doesn't that mean the person who's 35 had to work until he's 70 before he can retire? But the retirement age is at 60 officially.
Okay, I would say that, I see this all the time that people like try to borrow as much length as possible, like 35 years, right? Then assuming, let's say you borrow, Singapore, very rare you hear people borrow 35 years, quite rare, because the industry standard is none other than our HDB, right? Which is our public housing arm. And our housing public arm, the maximum they allow people to borrow is 25 years. We never go above 25. So usually we just borrow 25 years. After that, we sort of retire from there. We don't have to worry about paying rent. So